Now let's talk numbers. This is where the difference for non-residents become most apparent. The loan to value or LTV ratio is perhaps the biggest difference. While UAE residents can often get loans for up to 80% or 85% of the property's value, the non-residents typically get between 50% and 75%, with average being 60%. So this means as a non-resident, you will need a larger down payment. So you may have to provision for about 25% to 50% of the property value as your down payment. For off-plan properties, the ones still under construction, the down payment can be even higher, sometimes 50% or more upfront. This is because banks see an off-plan property as a higher risk. So be prepared for a substantial upfront cash outlay if you choose to buy an off-plan in Dubai as a non-resident. Now, what about the interest rates? So for non-residents, these usually range from 4.5% to 6% annually. They are generally higher than what residents pay, often by about 0.5% to 2%. You will typically have two choices, fixed rate or variable rate. A fixed rate mortgage means your interest rate stays the same for a set period, usually 1 to 5 years. This gives you predictable monthly payments. After that fixed period, it usually switches to a variable rate. Now, if we talk about the variable rate mortgage, this type fluctuates with market conditions, meaning your payments can go up or down. Variable rates often start with a lower rate. The variable rates are linked to IBOR, which stands for the Emirates Interbank Offered Rate. This is the benchmark interest rate for lending between banks in the UAE. So, if IBOR goes up, your variable rate mortgage payments will likely go up too. Now, let us come to the loan tenure, right? So, while residents might get up to 25 years to repay their mortgage, non-residents are often offered shorter durations from 15 to 20 years. A shorter loan term also means higher monthly payments, but it also means that you pay off the loan faster, which is good. Banks do this to reduce their long-term risk with non-resident borrowers. To give you a quick comparison, think of it in these terms. Loan to value ratio, residents 80 to 85%, non-residents 50 to 75%. Down payments, residents 15% to 20%, non-residents 25% to 50%. Interest rates, non-residents pay 0.75% to 2% more than the residents. Loan tenure, non-residents often get shorter terms. Credit history, residents use UAE history, non-residents use home country credit reports. Minimum income, non-residents often face higher minimums. So now you have assessed your eligibility and understood the financial landscape.